Well, thank you very much for joining us today. My name is Marc Montini. My company is the Montini and Company Tax Advisory Group. And today, for the next 10 minutes or so, we're going to talk about what really goes into retiring. How do you retire? Just real briefly about us, we are a tax and financial planning firm, so we are a one-stop shop for all your planning needs. I am a licensed fiduciary. It means any recommendation I make on the financial planning side of my practice, those recommendations must be made in my client's best interest. Been in financial services now for 28 years. And what we really specialize as a company is tax reduction strategies. Once you're in retirement, if we can work to understand how your Social Security is taxed, where your money is coming from, we can reduce or eliminate any taxes that you potentially could have in retirement. Do a lot of retirement income planning. You'll see that here in the next 10 minutes. We do assets under management. That's part of the financial planning side of things. But we also do taxes, and our tax returns start at $175, and they go up very modestly from there, depending on the complexity of your return. So what we're going to talk about here is how to retire. Some of the things that we're going to that we need to take into consideration is your Social Security benefits. What is your desired retirement age? What's your estimated life expectancy? Do you still have parents that are around? And if so, what does that say about your life expectancy? What are your monthly income needs? This is very important. We're going to talk about this here in a little bit. And then we need to build a plan. When we have a roadmap that tells us where our money's coming from, that it is sustainable, and it is being taken in the most tax efficient manner possible. But we also have to think about inflation. Obviously, that's a big part right now. Taxes, where are taxes going? What are your risk tolerances? The sources of income that you're going to have. Is a Roth conversion appropriate? And what investment options do you have? And lastly, really don't try to do this on your own. Retirement is not easy, but with our help, we can get you there. Now, speaking of life expectancy, according to the Social Security Administration, if your current attained age is 65, now this is both male and female combined, if your age is 65, your life expectancy is 85.7 years. If your age right now is 70, your life expectancy is 86. At 75, it's 88, and so on. So realistically, your retirement could last 20 to 30 years. So we have to take longevity and life expectancy into consideration, because running out of money is not an option. Now, what is your monthly income need going to be in retirement? This is tough for a lot of people, but with our help, we will get you there. This is my expense organizer. And on this document, it lists pretty much every expense you're going to have in retirement. And all you do is plug your numbers in, and it will sum everything up for you. But as you're going to see, this is of vital importance that we really nail down how much do you need to live on each month, and not just survive. Right? Retirement is not about survival. It's about living. So we want to make sure we're taking into consideration vacations and dining out and spoiling the grandkids. All these things are what go into your target monthly income. Now, when we have that target monthly income, we can build a plan. And this is what my income plan looks like. This is a proprietary document that I created in conjunction with my CPA. And what we do here is we start in this top section with what type of guaranteed income do we have coming in? Okay, this is going to be a pension, Social Security, rental income, any income we know that's guaranteed. We then look at what is that target monthly income. In this example, this person needs $7,400 a month. And so we then take the guaranteed income that we have. We have our target monthly income. If there is a surplus, then great. We don't need to convert any assets into income. If there is a deficit or an income gap, then we turn to the assets and we figure out, okay, how do we convert those assets into income and do so in the most tax efficient manner possible? My income plan also comes with a corresponding tax model. And on this tax model, which is the line here and everything below this blue line, in my corresponding tax model, it will tell us if we can convert and what dollar amount we should convert and what taxes we would want to have withheld if we proceed with a Roth conversion. So it does a lot in this document, but it tells you where your money's coming from, that it's sustainable, and that it's being taken in the most tax efficient manner possible. But it also is an important tool for me because it tells me how we should be invested. We always want to make sure we're invested with a purpose. Okay, why am I putting my money here? What is this doing for me? And the income plan will give us that direction. Now, in retirement, there really are three phases of retirement that we focus on. The first phase is going to be the accumulation phase. This is where you're still working and you're maybe contributing to a 401k and you're putting money aside, where you may be a little bit more aggressive because we're looking in the future for what our retirement's going to be. Once we get into retirement, then we enter the distribution phase, and this is where, if necessary, we're going to convert the assets that you have into sustainable income. Now, once your income needs are all met, then we're going to get into a preservation phase. This is where we're going to start looking at wealth transfer and where those dollars are going to go should something happen to you. Now, we have to understand risk, but not so much about how much are you willing to lose. Let's change it to how much time do we have to make up for potential losses. So at the top of this chart here, you have $100,000. You lose 10%. You now have $90,000. But you got to make 11.1% just to get back to where you were. Okay, that's reasonable. Markets have a down year. We have the inevitable rebound year, and we can make our money back. But what if it's something more substantial, something like what we've seen here in this year, where maybe you're down 20 to 25%? Well, if you lose 20%, you got to make 25% just to get back to where you were. If you're down 25%, you got to make 33% to get back to where you were. So we think about in terms of time. How much time do you have to make up for potential losses? Now, a Roth IRA and converting your traditional IRA to a Roth is something we may want to consider. Now, I do have a separate 10-minute webinar dedicated strictly to Roth conversions, and I would definitely encourage you to watch that. But a couple important things regarding the Roth is that how much tax you're going to pay on your Social Security is dependent on the income you have other than Social Security. Okay, so Roth income is not reportable. And what we're trying to pay attention to is if you're married, keeping that other income outside of your Social Security, but keeping that other income under $32,000 if you're married, under $25,000 if you're single. If we can do that, then none of your Social Security is going to move over to the income column and be taxed. So we want to be very conscious of those other income sources that you have, and a Roth IRA can be a great source of additional supplemental income. What we then do is we use the standard deduction to offset any taxable income that you may have, and that's how we can get to that zero tax or a minimized amount of tax that you're going to be paying in retirement. Roth IRAs are also very powerful wealth transfer tools. Something happens to you, that money goes tax-free to your spouse. Something happens to your spouse, that money goes tax-free to your kids. So a Roth IRA can be a really powerful tool, and we can fund that Roth by converting your traditional IRA into a Roth. Now, as I mentioned earlier, I am a licensed fiduciary, and what that means is a fiduciary has a legal obligation that any recommendation they make, it must be made in my client's best interest. Now, when it comes to managing assets, there's really two primary paths you can go down. You can go down a passive management route or a tactical management route. A passive management route would be more of a buy and hold type philosophy. This is kind of like the old stockbroker model where you see a stockbroker and he sells you stocks and charges you commissions and fees to do it, and you don't see or hear from the guy for 3 years. Well, then you go back and he looks and says, oh, those stocks are horrible. Let's get out of those and let's buy these. Again, charging commissions and fees. But that's not management. That's very passive. What we want to focus on is tactical money management. Tactical is action. Somebody's watching your money on a daily, weekly, monthly basis, and they're adjusting the holdings that you were invested in based on what the economy dictates you should be invested in. For example, stock market's not having a very good year. So none of my clients are invested in stocks right now. Okay. We have to find the investment vehicles that best work in these current economic cycles. Now, also, when you are planning for your retirement, you're going to meet two types. You're going to meet the Wall Street type, or you're going to meet the insurance guy. The Wall Street guy wants you to put all your money into the market. Now, that's not bad because that money is invested. It is liquid, and you can get out. You can make changes. So that's not a bad option. The insurance guy wants you to put all your money into annuities. Now, annuities aren't bad because they give 100% guarantees against stock market losses. The downfall of the annuity is that it's not as liquid as we'd like it to be. Typically, the insurance company will only allow you to take out 10% each year. For us, we love the liquidity that we get from being invested. We also love the guarantees that we can get with certain annuities. So we want to find balance between liquidity and guarantees. Now, when we're talking about tactical money management, okay, we are adjusting the holdings based on what you're invested in. And these asset classes change over time. So on this chart here, what we're looking at is at the top of the chart, these are the best performing asset classes for each year. At the bottom of this chart, these are the worst performing asset classes for the year. So the challenge is here, if you look here in 2017, emerging markets had a great year. You made a lot of money in emerging markets in 2017. But in 2018, emerging markets were the worst performing asset class. Okay, so what you get with tactical money management is somebody's watching and they're adjusting those holdings based on what the economy dictates. Now, a couple review questions here that you need to pay attention to as you approach your retirement. It's number one, how much monthly income are you going to need in retirement? That is a very important number. And again, if you don't know what that monthly income need is, I can get you there. I'll give you my expense organizer, and we can figure out what is that target monthly income. How much stock market volatility and risk are you willing to take? Again, position it more in terms of time. How much time do you have to make up for what potentially could be lost? How are you going to plan for taxes, inflation, interest rates? We know inflation is very real right now. We also know that potentially taxes are going to be going up. We're at $31 trillion in debt. And right now, tax rates are at near historic lows. So potentially we could expect the taxes are going to go up. So we need to plan for that when we're putting together your retirement. How much liquidity are you going to need in the event of an emergency? In retirement, things happen. You're going to need to put a new AC unit on. You're going to need to put a new roof, on your house. You're going to need a new car. Things are going to happen. And so we always have to make sure you have plenty of sufficient liquid assets on hand to come up and meet those life's little mysteries. How are you going to protect your spouse if something were to happen to you? At some point, we have to address our own mortality. And strictly speaking, from Social Security, if something happens to you, there will be loss of income. The surviving spouse is going to get the higher of the two Social Security payouts, and that lesser amount is going to go away. So we do need to plan for loss of income should something happen to you. Now, what steps do you need to take to get started? Well, this is a great first step. I hope here that you've learned a little something from this. Keep your education going, okay? We do teach a full 1-hour class every Thursday night at 6 o'clock. You do need to register for that class, and you can register at phoenixsocialsecurityclass.com. That is phoenixsocialsecurityclass.com. As you can imagine, we talk a lot about Social Security planning in that class, but we talk about a lot of other things too. So don't try to do this on your own. Get on my 1-hour class every Thursday night at 6 o'clock. And lastly, if you liked this content, if this was helpful for you, then please share it with your friends and family. Retirement's a lot more fun when you can do it with friends. Thank you very much. I hope you enjoyed this, and I hope that you join my 1-hour class.